Good afternoon. Today is Monday, the 2nd of May, 2011, and this market review is brought to you by Realtic. They're the trading platform that I use each day, so be sure to check them out at realtic.com. And let's take a look at this market here. The S&P 500 has enjoyed a nice rally here over the last week and a half, 2 weeks. And today, with that gap higher, based on the Osama news, obviously we had gapped up and had not held on to those gains very well. That became apparent really when it broke down below that volume weighted average price and then took out the low of the morning right here at about 136.70. So it appears as though the S&P 500 is at least going to test that 5-day moving average. I think that's a given here in the next couple of days. And it doesn't even have to drop any further. By tomorrow afternoon, the 5-day moving average will have rallied up to there. But we've seen this market come pretty far, pretty fast here. It's expended some good upside energy in this rally from 129.5 up to 37.5, basically. If we take a look at Fibonacci and say, maybe we get a pullback of 38%, then that could bring us down as low as about 134.20. And when we look at the daily time frame and say, well, what's in that area? Well, right now we've got the rising 10-day moving average in there. And really, if you remember, 134 is where we have broken the neckline of that inverted head and shoulders pattern. And that's, if we pull back to 134.20ish, I don't think it's going to turn this market bearish. We still have a strong uptrend on the daily time frame, but it does seem prudent here to kind of stand back a little bit and let the market settle in. It's not, if we look at the last corrective little correction we had here that took place after this rally in mid-March, we had turned sideways a little bit, pulled back, and then the buyers had taken back control. So stage 1, stage 2 accumulation, stage 3 distribution, stage 4 decline, stage 1 markup. We're still in that stage 2 uptrend, maybe turning more to a stage 3 distribution, and I think that breaking below probably about 135 and a half would you would want to get a lot more defensive and maybe expect for a test of that 134 area. So it's not time to get outright bearish in here, but a lot of stocks, if you're getting stopped out, listen to the message of the market. That's what the stops are there for. They're meant to take you out before things get a lot worse. And as far as buying, don't try to guess that it's going to hit the 5-day moving average and you need to stick a bid in there. That's a potential level of support, and really, if you look at the way the other markets are trading, it might not even hold there. The Nasdaq looks a little bit more distributive here on the shorter term time frame. We've got that 5-day moving average kind of flattened out, and we've basically gone nowhere for about the last 4 or 5 sessions here. So I think you break below today's lows at about 58. Let's just call this 58.85. Below 58.85 for more than a half hour or so, then I think you want to get a little bit more defensive as far as the Nasdaq goes, and perhaps we would see this market pull back down towards 58 to 58 and a quarter. 58 and a quarter really is kind of where this market broke out from. We've got that rising 10-day moving average in there as well. The Russell was a little bit weaker here today as it lost $1 or about 1.1%. And this market's been the leader of the upside. It's been a little bit more volatile, and that's to be expected. But there's clearly, you look at the weekly chart, you look at the daily chart. There's nothing bearish going on here. It just looks like a little pullback, and we could come up with a similar measured move type upside if you take that from 77.5 up to, let's just call this 85.5. So that's about 8 points. That would be A to B. Then we take B to C, and then we go from point C up, which is 81.5, and add that 8 points from the A to B, and we would get about 89.5 as a potential upside target. Now, it doesn't mean that we should be looking for that, because obviously we have now lower highs and lower lows here, and it looks like the Russell needs to pull back a little bit more through price and maybe correct sideways a little bit through time as well. This area down here near about 84.30 could be where we find a little bit of support. We could put Fibonacci retracements on here as well and say, just a 38.2% retracement will get us down to 84.5. So it seems as though it's time to play a little bit stronger defense in all of these markets. We've had it pretty easy the last couple weeks. Make sure you hang on to those profits and that you're not trying to, you're not getting greedy with the market. Basically, the semiconductors have also kind of turned a little bit more neutral in here. On the daily time frame, they've been battling this level up at 3680 or so, and not being able to breach that is not a big deal. I think a little bit of a pullback here could be the pause that refreshes this market for a break past these levels. But for now, on the 10-minute time frame, I think it says we want to become a little bit more defensive and listen to the cues of the market. If we get back above 3650 and hold there for a half hour or so, it could be game back onto the upside for the semiconductors. Financials were down 7 pennies today. The daily chart, we're kind of battling that 50-day moving average once again, and back looking at the 30-minute time frame, maybe we're just starting to turn a little bit more neutral in here. So if you're leaning negative towards these financials, I think that maybe you get below that 1630 for a half hour or so, and then we could begin a slight downward movement in there. Again, overall, it's time to play a little bit stronger defense. The big volume, the big news is this. It continues to be silver. We've seen massive volume here the last week and a half without further upside. So further, big volume without further upside equals distribution. It was pointed out to me over the weekend that from the people at Mr. Top Step, that the margin rate for silver itself, the SI contract which really started out weak last night. But anyways, it was pointed out to me that the margin to trade the silver contract was recently raised, and they've basically doubled it from what I understand over the last couple weeks, and so a lot of people are liquidating because of that increased margin. And now the big volume has come into the silver because this is basically a way that you can trade 100 shares for $4,000 without putting up that $25,000 to trade the silver contract. So in other words, the SLV has become the poor man's way to trade the poor man's gold.